Welcome to the Dividend Talk podcast, episode 108. How to make sure your dividends aren't cut during a recession. Hey guys, welcome back to another episode of Dividend Talk. Today we are joined with Joseph Hogue, CFA, aka Mr. Bowtie, where we will talk about how to make sure your dividends are not cut during a recession. All that and more. See you on the inside. Good evening, European DJI. How are you today?
Actually, I'm really excited because today was my last day at work before the vacation. You know, we're Europeans. I had first 2 weeks vacation at the start of June. Now I will have 2 weeks vacation at the start of August, and I still have more than 20 days left for this year. So I feel really good, but equally excited because we've got a great guest on the show today, and we know him, of course, as Mr. Bowtie.
Yeah, we have Joseph Hogue on today, which everyone knows from YouTube as the guy with the bow tie. Joseph, welcome to Dividend Talk, and thanks a million for joining us today.
Derek, it's great being here. Thank you. My pleasure. And I think, if excited, equally jealous, talking about your vacation time there, because here in the States, I think we've got about 12 holidays, and that's about it. Maybe about 10 vacation days a year, and after that we're SOL, I guess.
Yeah, it's quite crazy, the difference. My sister lives in New York, and she only gets 10 days, and I get 31 days, and
Wow.
I can carry them over as well. So the difference is quite amusing for me, actually.
That would be amazing.
Yeah, but in America, they get like proper dividend growth stocks compared to Europe. So, you can't have it all, right?
No. And I imagine you guys have to make it up, right? You work 12 months in 11 months time, and then just take the 12th month off, right?
Yeah, exactly.
Yeah, and don't underestimate the sick leaves, right?
There you go.
So maybe, Joseph, for those listeners that maybe don't know who you are, maybe you might just give us a brief intro about who you are and what you do.
Sure. Well, I come from an equity analyst background. After serving in the military, then I started in venture capital. After going to college, of course, then went into venture capital, equity analysis, and then private wealth management. Just really loved that idea of making my money work for me, right? Instead of always having to work for my money. So I did that for about 10 years, working as an equity analyst. And in 2014, really decided that I wanted my own business, wanted my own assets instead of always having to work for someone else. So I started blogs first in 2017. I switched it over to YouTube, and I have just loved it. The growth has been exponential, really surprising. And I love that face-to-face connection you get with people through video on YouTube and that kind of thing. Really a sense of community with that. I love talking to Main Street investors, really kind of why I made that switch. Always with venture capital and private wealth management, you're always working with that 1%, right? The rich and the accredited investors. It's really great to be able to take that experience, bring that experience really to Main Street investors and share that as well.
That's pretty cool, and it's a pretty cool story, actually, and how you go from the military into finance. That's for me, that's something quite interesting. And I know it's not the topic today, but sometime I might pick a brain on how that actually happened. But
well, I was an armorer in the Marine Corps, which first of all, being in the Marine Corps, you don't get a lot of job skills unless you're going to be I don't know, doing something like that after the military. But even more so, being an armorer where you're fixing small arms and guns and things like that, there's really only one job you can take after the military with that. And I didn't want to be an armorer for the rest of my life. So I went back to college and really, found that passion in investment analysis and making your money work for you.
Nice. And so far it looks like it's going well for you. So
sure.
So at this point, we usually discuss maybe some of the news of the week. I know there was a lot of earnings that happened, and European DJI, Intel is probably on the top of your list. It didn't look too pretty, the numbers, when I looked.
Well, that's, I think, an understatement. I didn't even hear people choosing the words bad or something like this. Was everywhere horrendous, horrible, disaster. And I must confess, I'm now for 6-7 years reading quarterly reports. I think this is the worst I've ever seen. That caught me by surprise. I mean, IBM is just, it's clockwork that they are kind of bad, but with Intel, it was horrible. Like, I don't have any other words for it. And if you think about it, their free cash flow could have even looked worse if they would have had the capital expenditures that they committed to. Yeah, so they've been actually underinvesting to make the free cash flow numbers even look a bit better still. So this someone is eating their lunch here, and I have a feeling that we will observe that next week when the AMD earnings come out.
Yeah.
Well, what'll be interesting is really seeing, how Intel earnings stack up against AMD, against some of the other chip companies, because Intel it's just been so frustrating and so disappointing, right? Because this used to be such a strong company, such a bellwether for the chip market, and they've just squandered it, right?
Yeah.
I do think they've done a really good job at being in the ear of the administration, really two administrations in Washington now, that they've been talking up domestic chip production, really been the guiding force behind the new bill that they signed. So I'm hopeful that they're going to get a lot of benefit out of that new bill, but management just has not been good for that company.
No.
Yeah.
And what we can see, it has kind of a 5-year lead time, right, to set up the whole production for this and to catch up. So AMD has been doing this for 5 years. Specifically, the former CEO was not acting on it. He was just really in inertia. And Pat Gelsinger, I think he has really good plans, but he needs to get through this phase and take all the shit on him for the upcoming 2 years still, because it's dirty at the moment.
Yeah, it's like they were caught with their pants down, wasn't it? It's like they were not expecting this decline in revenue, and I seen there's further delays on some of their chips as well. So it's not looking pretty over the short term for these guys, but hopefully, look, long term the demand is there. So surely Pat can make something of this company, but time will tell. How about you, Joseph? I think you wanted to mention something about Procter and Gamble, I think, was it?
Sure. Well, I think it's just really the overall revenue growth picture we're seeing in earnings, and I think Procter and Gamble is the perfect example of that, right? Procter and Gamble today reported their strongest organic sales growth in a quarter since 2001, and that was when they started measuring it. So it could go back even further back than that, but they reported 10% year-over-year organic sales growth. And now remember, this is a consumer staples, this is a household products company. I don't know about you guys, but I'm still buying the same amount of toothpaste I used to. So where they're getting that organic sales growth is strictly from the higher prices. And I think investors are loving that revenue growth picture that we're seeing out of companies, but kind of overlooking the obvious consequence of what this means, right? Companies in the S&P 500 are reporting 10.9% sales growth on a year-over-year basis for this second quarter that they're reporting now, but only 4.8% earnings growth, right? And really, it's interesting because that's usually the opposite, right? They usually report lower, maybe 3, 4, 5% sales growth, and then 8 or 9% earnings growth because they're leveraging up those sales through through operations and through debt and things like that. But now they're reporting these massive sales growth because they're raising prices, but then they're eating a lot of that inflation. They're seeing a lot of those operational costs go up, and only 5% earnings growth. And I think it really just points to the fact that inflation is here to stay. It's going to be more persistent than people expect. With those prices going up, people are going to be demanding more wages, higher wage growth. And I think that's just going to continue that cycle that feeds into itself and keeps inflation going up.
Yeah, I think you're really on point there. And I don't know if the same is in America, but in Europe at the moment, the airlines are like really having troubles. Many flights being canceled, workers just not willing to show up. We have farmers protesting, blocking highways and such, also because of climate deals that are being made. Are also like workers in your area, let's say, also already protesting and such, because it's hard for them to keep up with inflation as well, right?
Sure. And The unions do have a stronger bargaining power over the last couple of years, just with with the Democrats in Congress, as is typically the case. But it's not quite there yet. I know the airlines are having quite a few problems, just like they're in Europe. We're not seeing it in a lot of the other industries, other than some of these e-commerce. I know Starbucks and Amazon are both seeing quite a bit of their own kind of union problems. But we are seeing higher wage growth, and yes, kind of a momentum in that bargaining power of the workers. And yeah, now don't get me wrong, that's great for the workers, getting higher wages and having more bargaining power. But for investors, you kind of have to disassociate yourself. You have to be dispassionate about your investments and look at what that really means for the bottom line earnings of these companies, and understand that it is going to hit those earnings, and and that's really the value of your stocks.
Yeah. Okay, that's pretty good. We might move on to some of the rapid fire round, if you don't mind. European DJI, have you got some questions?
Yeah, definitely. So, Joseph, it's really simple. I give you two options. You just choose one. I've got five options for you. Let's say, or 5 questions, and then you can clarify some afterwards. Okay. So the first one is, and I don't know how to say it actually, but American football or ice hockey?
Oh, American football all the way.
Good. Intel or IBM?
Oh, I'd have to go with Intel.
High growth and low yield, or high yield and low growth?
Man, that's another tough one. I'd say high yield, low growth.
Starbucks or McDonald's?
McDonald's all the way.
And then the last one, Katie Wood or Elon Musk?
Kathy. Okay, Kathy.
Kathy Wood.
Kathy Wood is Katie Wood. Is that like Katy Perry? Because I would definitely go Katy Perry over Elon Musk. That's not even a choice. Okay, Kathy Wood or Elon Musk? Oh, I would go Kathy Wood, I guess.
Super. Is there anything you like to clarify about your choices?
Wow, like everyone. Okay, so McDonald's, you can't beat the breakfast. Come on. So Starbucks, I get my Coca Mocha latte cappuccino, but that's about it. McDonald's has it all. Intel, IBM. Wow, I mean, just 2 train wrecks against each other, right? Which one do you pick? I do believe Intel, if they can turn it around and regain some of their glory years, then that could be a great rebound story. Unfortunately, of course, we've been looking for that story for the last 10 years. The yield and growth, I tend to invest value and yield or dividend stocks, broadly, but then growth selectively. And I think that's a great way to play the markets. Really getting those value stocks on a market wide basis, getting some of the best dividend stocks out there, but then selectively picking a couple of growth companies just to give your portfolio a little bit more growth, a little bit more return.
No, super cool. Thank you.
I think that actually leads us nicely into our topic, and I know we're going to talk a little bit about how to make sure your dividends aren't in danger of being cut in a recession. But just before that, do you remember your aha moment when you first discovered investing, or maybe investing in dividend stocks?
I do, but if we're not going to talk more about Katy Perry, then I don't know. Okay, yeah, actually, I do remember when I first started investing in stocks. Actually, I was in the Marine Corps. It was 1999, and I was sitting in the library in the my duty station there at the station, and because of course back in 1999 nobody yet had their own computers and the internet and all that. So I was in the library using the computer and opened up a Brown and Company platform. I opened up a Brown and Company account that later would be bought out by E-Trade, and started investing. So 1999, a great year to start investing, because we all know what happened the year after that. But I think it was good in a sense that now I can relate really well to a lot of the people that just started investing over the last couple of years and have now seen their investments crash so horribly. Learned a lot of things from that experience that I can, pass on to them.
So what did you learn?
Sure.
What are the lessons you could pass on?
One is, just don't be just chasing those momentum stocks. It's great. Like I said, I do like investing in growth stocks, it's kind of selectively picking out some of those stocks. But when you base your entire portfolio, and we've seen this a lot over the last couple of years, people thinking stocks only go up. So I'm going to pick the stocks that are going up the fastest. When you base your entire portfolio on those momentum stocks, that gets to be a problem when they're not working, right? When the market does crash, because they come down harder than any. So you really need a bigger, more diversified portfolio, not just in value and dividend stocks and that. You can have some growth stocks as well, but having some different themes there, and understanding what momentum investing really is, not just investing in those fastest growing stock prices, but understanding, okay, when to take profits and things like that. Also, not understand the difference between a stock and the company, I think was probably my biggest lesson, because back there in 1999, I of course heard about a little company that was just starting up called Amazon. They had just went IPO in 1997, and by 1999 they were up to about $100 a share, which was pretty insane at those levels. And I bought some shares. It started coming down, of course, in the dot-com bust. And I sold, because, if the stock price isn't going to make me rich, then it must not be a good company, right? That stock ended up bottoming out at about $6 a share in 2002. And of course, I was glad I sold, right? I got out while the getting was good, and didn't look back until, of course, it started going up again. And right now, so before the split, so that was, $100 a share at the peak, about $6 a share at the bottom of the dot-com bust. And we know that just last year, before the split, Amazon was trading at $3,500 a share. So about would have turned about $1,000 into $500,000 on that one stock. And I think it's really instructive for people that are investing over this last year. I've seen a lot of those growth stocks, the Teladoc, the PayPal, the SoFi Technologies, just obliterated, down 70, 80%, and are thinking that, those growth stocks, the stock price has come down so much, it's not a good company anymore. But the problem is, some of these are still very good companies. They are changing the world in which we live. And one could be the next Amazon over the next 10 or 20 years. So really looking at those companies, and evaluating whether it's still a growth company, even if the stock isn't a growth stock.
Yeah, and that's I think also one of the most difficult things when you invest, let's say, for growth. Because for me, at least, if I make mistakes, I often still have a dividend in return.
Sure.
But for instance, think about investing in biotech stocks. You need to be a biologist to understand what it is about. If you invest in consumer staples, you really need to understand the supply chains there. The same with Intel that we just spoke about. You need to understand a bit of the technology as well. And the world is only becoming more specialized and more technology advanced. So it becomes harder for us, I think, as investors also to truly understand the power of a company. And that's one of the reasons why I struggle also always with growth stocks, because then people say you need to use price to sales and all these kinds of things. But it's really, really hard for me to see successors popping up in this, specifically also where the stock price, the stock is of the same quality as the business, let's say.
Yeah. And really, that's what Peter Lynch was talking about, right? When he said, invest in what you know. He wasn't just saying, if you like McDonald's breakfast, then invest in McDonald's because you like their breakfast. He was talking about having that deep knowledge within an industry and within a sector to be able to really evaluate the operational, the performance of those companies. So I think what's helpful is to, just invest broadly in, market indexes, in sectors, and in themes, but then find those industries where maybe you have a professional experience in, or you can build that kind of experience, and invest selectively in the growth stocks in those industries. So, you may not be investing in biotech because you don't have a pharmaceutical background. You might not be investing in semiconductors, but maybe you can build that experience in e-commerce or in some of these other growth industries, and really be able to selectively pick some of the companies out of that.
Yeah, that's some pretty good advice. I mean, I struggled a lot with that. I come from an engineering background, and automation is probably my main area. So I know quite a bit about automation and in that world, but I struggle when it comes to finance or REITs and all these other non-technical stocks. So I think that's some pretty good advice. But we're here to talk about how to make sure your dividends aren't in danger of being caught in a recession. So how do we do that? What do you look for in these companies?
Sure. Well, it's actually some of it's going to be the same that I look for in any company, really: a sales growth and operating margin relative to their peers. I think sales growth relative to peers, and of course, I say that because it's so important. People look at overall sales growth. They look at maybe some of these valuation metrics, and they just compare them across all stocks. And it really tells you nothing, right? If you're looking at sales growth for Procter and Gamble versus sales growth for Tesla or something like that, right? Because it's completely different business models, completely different industries, and dynamics. So you always need to use your measures against the peers in the industry, and really, I think looking at the sales growth, looking at the operating margin, and picking out the companies that have stronger, that can grow their sales faster, it really gives you a sense of which ones might have competitive advantage, right? If the industry is growing on average by about 4% a year on sales, then why is one company able to grow their sales by 6 or 7% and presumably taking market share from a lot of others, right? Operating margin as well. Why are they able to be more efficient on a relative basis versus their peers? So I think it really helps to pick out the best companies, the best of breed companies. Within dividend stocks particularly as well, you want to look at the payout ratio, right? How much of their earnings are they committing to that dividend? And that's going to be a great safety net when it comes to when cash flow problems do come up in a recession. Whether, if they've got a lower payout ratio than their peers, they're going to have a little bit more leeway generally. Also lower debt to equity than their peers, and that interest expense that they have committed to pay. One of the biggest problems we see with dividend stocks, since these do tend to be more mature, stable cash flow companies, they have higher debt, right? They have more stable cash flows, so they can take on a little bit more debt and generally not have a problem with that. Where we see the problem is in stocks like IBM, stocks like AT&T, where they get into this acquisition, growth by acquisition, and they just put on tens of billions of dollars worth of debt. Of course, these acquisitions never turn out as good as they thought they would, but the interest expense is still there and it's still growing. So I think that's really where you see a lot of the problems when it comes to dividend cuts, when it comes to dividends, dividend companies is that debt to equity. So I think that's really instructive to measure that relative to peers and looking for those companies that are going to have some leeway. I'm also looking for total return on the shares, right? Rather than just the yield. I love that cash flow. I love the dividend payment, but I want to see companies that are rewarding me through capital appreciation and the stock price over time as well.
And regarding the debt, Joseph, do you also feel like that over the last, let's say, now since the great financial recession, that the monetary policy has made it also more difficult for companies, but also the Fed and such right now? Because for me, it feels like even the higher quality blue chip stocks, they went full into buybacks and everything, leveraging debt, interest payments. So, where, for instance, in the past, maybe a 60% debt to equity was considered safe for some industries, I have a feeling now you rather need to look at 40 or 50 or something like that, just because of the interest payments going up, or maybe it's more from the payout ratio point of view, let's say, because it feels like we're coming off a historically very low bottom, right, with interest payments.
Sure. Well, it's definitely got to be something you look at because, and I wouldn't begrudge a management that did use a high level of debt through that used debt to buy back some shares, possibly even because interest rates were so low. I mean, how could you not? How could you not take advantage of that? But you're right. You have to look in there and say, okay, you know what? Now how does that debt look if interest rates are going up? What's the debt maturation cycle or debt maturity cycle that they have over the next few years that they're going to be looking at having to having to refinance some of that debt, and what prices are they going to get. That buyback program is really important as well. One of the things I look for in a dividend company, and to know which ones might be safe during a recession, is companies that do have that buyback program that can cut that before they cut their dividends, because it's really all about protecting that cash flow.
Yeah. And how do you then look at a company like Starbucks that has a negative equity as a result of buybacks, where it feels like there's more debt than assets on the balance sheet? It feels really unnatural. And what is your approach to this when you analyze such balance sheets? Does it feel okay for you, or is this something that we should be aware of as investors?
Sure. Well, it's fairly rare, I think, especially for large established companies, dividend companies like that. I think I would look first at the goodwill and intangible assets. What have they been doing with those? Because generally, especially for the large dividend companies, they're going to have more assets than that debt. If they've been putting on so much debt that they've got a debt to equity ratio of more than 100%. Then I would think that was a problem. That is a problem. I would wonder why they were putting on so much debt. Was it that growth through acquisition strategy? Was it just to buy back shares? Which, especially if they were buying back shares over the last few years, while share prices hit peaks, that's obviously always kind of a red flag. And companies don't have a good history of buying back their own shares at a good price. So I would definitely think that would be a warning sign, right? Because like you said, rates are going up. That debt is going to be getting more expensive. And for consumer staples companies that aren't going to be able to raise their prices like they have this last year, and have that generally slow sales growth and slower cash flow growth, then if their interest expenses is rising quite a bit over the next couple of years, that's gonna really weigh on earnings.
Mm-hmm.
So you have a company that passes all your screeners as good growth, and then they cut their dividend. I know you're looking for total return here. What do you do in that situation?
Sure. Well, that's always a kick in the nuts, isn't it? Getting kind of caught with that. You've really got to evaluate whether it's still a good long-term investment. Was it management that was just making horrible decisions, and that really hit that cash flow, or was it just the overall market? So again, you're going back to the industry, you're looking at the competitors and things like that. Are they getting surprises on their cash flow as well, or can you really say, what, management has just ruined this company? I think AT&T there is another great example. Over 10 years or more, really, management had just destroyed that company with its acquisitions and poor decisions. I think they've turned the corner here with this strategy, going back to their roots, going back to telecom. But the writing was on the wall for the dividend cuts there, and even after. It's generally, if there is a surprise cut, an announcement, it's generally too late to sell the shares immediately, because the market, of course, is pricing that in now, and the stock price has fallen quite a bit. So you've got a good couple of weeks, I'd say, usually, to make that decision, to really go back into the financials and evaluate the company, to see if you want to sell it now, because a lot of times you'll see that big sell-off when the dividend cut is announced. But then maybe something like a dead cat rally or dead cat bounce over the next week or so. So you've got that time to really make that rational, informed decision, instead of just rushing out to your account and selling all those shares immediately.
Do you still remember what dividend stock in your portfolio cut their dividend like in the last few years?
Last few years, I don't. I mean, there's, I own a lot of excuse me. I own a lot of dividend funds. So I'm sure they had AT&T in there. I'm sure they had a GE in there. I just started buying AT&T this year in December, when they kind of made that announcement that they'd be selling the rest of the AOL assets and getting back to their telecom roots. So I wasn't in that. GE, I've held it in the past when they had a dividend cut. So I did get caught on that one with GE in the past.
Yeah, GE is my worst investment from that point of view, because I almost believe Jeff Immelt. I mean, he wanted to build the windows for the industrial industry, and I should have known that by working in IT that it's utterly useless strategy
Sure,
at the time. But
sure.
yeah,
And I just yet another example, right, of so frustrating, because that company was just like Intel. It was the blue chip stock to own for so long, and did so well by its investors, and then management has just ruined the company.
So if you want to torture yourself, you should read the book The Lights Out, which is about the story of GE and how it became what it is today. And it gives an inside view on how management was also, in my opinion, just manipulating the numbers to look the end of the quarter look good. Like on the last day of the quarter, quickly still doing an asset sale or something like that to boost up the earnings, but then not, it's such a large industrial complex so that nobody would really see it in the books because it was on the details. So I always wonder, like, why did nobody of these guys ever got prosecuted, at least visible in public, right? Because if you read this book as well, which was really a journalistic work, there's kind of this, this privilege of CEOs that they often get away with things also by law, right? And how you're protected or shielded from bad management effectively.
Sure, yeah, that's interesting. I might have to do a video about that, because we do know that just looking at the income statement, there are so many different shenanigans that that management pulls to make the not so much the revenue always, but they of course they do move up revenue by extending credit terms, but just boosting those earnings by doing so many other tricks, accounting tricks, and really it's too bad that there's not more honesty, I guess you could call it, in the reporting.
Yeah, we always make fun here about adjusted free cash flow, adjusted EBITDA. Everything is adjusted nowadays. It's
not non-GAAP earnings. Yeah. Yep.
Yeah. Non-GAAP earnings, I sometimes can understand when it's like if you want to take currency fluctuations out or something like that, right? I can feel for it. But adjusted free cash flow, I mean, what is this? Yeah.
Yeah. Well, it's where you get a problem is when those recurring and non-recurring differences. When everything becomes non-recurring, and so that non-GAAP earnings is just ridiculously high.
I put one time 10 years of IBM earnings in a row, and we did a podcast on it. And we also looked at the press release statements of every year. And it was IBM Watson, it was right. Then it was the cloud. Then it was blockchain. And every year they had the next new big thing that the whole strategy would be set around. Nothing of that came almost to fruition. So effectively, Red Hat is saving them now. But you can see that the earnings, I think, went from $30 to $6 per share or something like that over the decade. And you can even see the gaps between adjusted earnings and normal earnings and free cash flow. And you can see that it's all the time restructuring costs in there, all the time write-offs on there. And the only thing I actually really see there is like poor management decision from the past, poor management decision from the past, poor management decision from the past, right? So yeah, IBM would be a good case study for that one, Joseph.
Yeah, definitely. Yeah, I always like to go back to operating cash flow or just cash flow, but really operating cash flow versus growth versus earnings growth, right? Comparing what they're actually bringing in as far as cash flow, and not to say that can't be manipulated a little bit as well, but yeah, what are they reporting as far as cash coming in and out versus what are they reporting on earnings? Because a lot of times you see a huge gap there in those, what they're able to account for.
And this is, by the way, one of the learnings that I had when I studied Intel's last 10-year track record, because the free cash flow was really high, but I now learned that this gap sometimes that is widening between earnings and free cash flow can also be a sign of underinvestment.
Mm-hmm.
And this is what happened in Intel. They've been just maximizing cash flow, but underinvesting for the future. And so going forward, I will look stronger at, let's say, the capex free cash flow ratio to see how that trends to competitors and over time in general.
Cool. Maybe just a couple more questions before we finish up on the topic. But
Sure.
I'd be curious to know: do you actually own any European stocks?
I don't. I own some international funds. So I have European stocks through those developed markets funds mostly. I think the VEA, the Vanguard developed market funds. So that has mostly European stocks there. It's kind of how I get my exposure, mostly just because I don't analyze the financial statements well for European companies.
Yeah, it makes sense. You guys got so many great companies over there. You don't need us over here.
Yeah. Well, I mean the accounting is different too. You guys have IFRS, right? And we have GAAP, so it's a little bit different, different financial statements. And I just never really wanted to spend the time, learning that GAAP to IFRS conversion.
Yeah, and and if you want to diversify, I mean, you mentioned Procter and Gamble, right? You have so many great American companies with a lot of sales internationally, so you can leave the companies having the impact of currency, right?
Sure.
Yeah. And what is then your all-time favorite dividend stock? Do you have any?
Oh, all-time favorite dividend stock. I'd have to think about that just a minute. Right now, and right now, I really do like a New York Community Bank Corp. That's ticker NYCB. It's a bank, smaller community bank, and the stock price, hasn't done that well. But I think the banks, the financials in particular, are coming into what could be, the best net interest margin period since the 80s. Really, great time, with those interest rates rising for the banks. This company, this stock, NYCB, pays I want to say about a 7% dividend yield last I checked, which is high even for the banks, right? So, so a strong dividend yield. I think they're coming up on a very good period as far as earnings and that kind of thing.
Super. So maybe then the last question regarding this topic.
Sure.
What would you advise to someone who's actually starting right now with investing in this period that might actually have a lot of fear of, if I put my euros or dollars in today with how the stock market is going and 10% later next month, right? What would
Sure.
you advise someone?
No, I'd tell them they're lucky as hell, right? For somebody just starting right now, they're already getting a 20% discount to where prices were at the beginning of the year, right? So just imagine if you had started 6 months ago or a year ago, and are now looking at a 20% loss. Those are the real ones that you got to console, I guess, right? If you're just getting started now, this is a great time to get started. For anyone, though, really just understand that the recessions and bear markets, it's just a fact of life. And besides giving us those discounts, like I said, we're down 20% now on the S&P 500. So you've got some great buying opportunities out there. These are just valuable lessons that we all need to learn, right? Those lessons like, just chasing momentum stocks, really doing the analysis behind stocks, and diversifying your portfolio, things like that. So, even if you've started 6 months ago or a year ago and you're looking at losses, it's not you, it's the market, right? The market has brought everything down, even the good companies. So, keep that perspective that it's a good opportunity to pick up some of those stocks at a discount now. Keep on saving, and keep on putting your money in stocks, because there's really no better return you can get.
So we have some questions from our listeners, if you don't mind. There's about 4 or 5. We might
Sure,
just
absolutely.
ask some. So Phil is a regular listener, and he has asked what he calls his standard question. I think he asks this to most guys we have on the show, but he wants to know how you would rank revenue growth, earnings growth, cash flow growth, and dividend growth.
Excellent. Great question. I would be cash flow growth first, right? Because it's less easily manipulated than a lot of your stuff on the income statement. So I'd be looking at cash flow first. Revenue growth would be second. That would be, and again, basically, I'm kind of using that as a proxy for competitive advantage for the company. So I'm looking at companies' revenue growth versus its peers, and why one company is able to get so much better sales growth versus others. From there, dividend growth, obviously very important, and something you want to look at that longer term picture. And then earnings growth, right? I mean, earnings are what it comes down to, but there are just so many ways that management can manipulate that on the income statement that a lot of times it's just a poor measure of how the company is really doing.
Dividend Wave has asked, which 2 or 3 companies are you most bullish on? So your longer term holdings.
Okay, so I've got a couple picks that probably would surprise people just because they've done so horribly over the last year. But I think they fall into that category of still good companies. One is Teladoc, which just had a horrendous quarter. They're marking down a lot of their goodwill, which is interesting because the stock was down something like 28% when they reported earnings just recently. And it was because of that, the goodwill, like a $3 billion impairment charge that they took, which really doesn't change how the business is performing or operating. It just changes, it changes their assets, right? Because they got so excited about these acquisitions and their intangible assets that they marked them up so high, and now they're having to mark those down. But it's still, it's still the leader in virtual healthcare, and I think virtual healthcare is going to be kind of a wave of the future. So I think it's a great stock to pick up at these prices. SoFi Technology, another growth stock that isn't necessarily a growth company or a growth. It's a growth company, but not a growth stock anymore, right? It's fallen pretty hard with the rest of the growth stocks, with the rest of the stocks that did so well over the last couple of years. But this company is a fintech leader. It's one of the very few fintech companies that actually has a banking license as well, right? So a lot of your fintech companies, they operate online, but they don't have a banking license, so they can't offer They can't offer the same rates as traditional banks. They can't offer savings accounts, checkings accounts, things like that. SoFi has that, and I think it's a huge advantage over the rest of their competitors. So SoFi Technologies. I also like, actually, surprisingly, I like Groupon still. It's not done well over the past, but I just started buying it here in January, and they've got a huge investment, a private investment in a company there in the UK called SumUp, which is a payment processing company. They own about 2.5% of that company, which turns out to be right around $400 million, just that one investment, and is almost as much as the stock is trading for right now, right? So they've got investment, they've got a lot of cash on the balance sheet, and I think a lot of really hidden value to that. Now, of course, it's another one that the management has just destroyed the company, and they need to get someone in there to turn that around. But I think that's a potential one over the next year, not necessarily a long-term stock, but a next year kind of thing. For long-term, again, I like that in New York Community Bank Corp, NYCB. I think it's a very strong dividend yield and coming into a very good time for the banks.
It's funny that you say about Groupon. I haven't used it anymore in the last 10 years. I forgot that it even existed, but now I remember that you always got a nice email, and then every day there was a deal. You could buy something. Damn, where did that go?
Yeah, that and another one that used to be the company, right? I think they got a $6 billion offer from Amazon or one of the larger e-commerce commerce companies wanted to buy them just after they went public for $6 billion. They're now trading for like $300 million. So obviously they missed that opportunity. And yeah, it used to be the e-commerce leader, the e-commerce, the big upstart. And now they've just kind of squandered that. But I think those assets, that sum up investment, as well as the cash on the balance sheet, if they can figure out a way to turn cash flow around, then there's a lot of value locked up and hidden in that company.
Ivan then has asked us, I think there's a lot of debate going on, he said Bloomberg and CNBC, whether the US markets are in a recession or technically in a recession, or are they not in a recession? So
sure.
What are your thoughts? What do you think on that?
Sure. I actually just did a video on that Wednesday, before I wanted to do it before the second quarter GDP numbers came out, because I had a feeling they were going to be bad, because the Atlanta GDP Now tool was actually predicting the quarterly loss, while most economists thought that they would be able report a growing economy, and we did end up seeing the economy shrank there in the second quarter after the first quarter. So that 2 quarters in a row of decline in GDP is a rule of thumb for a lot of people for a recession, but not the one that they officially use by the National Bureau of Economic Research, right? The NBER. They're the ones that actually officially say, okay, the recession started here, ended here, and make that announcement. Of course, we never know we're in a recession until one is obviously already started. I think, which obviously leads to a bunch of kind of oh shit moments, right? Or no shit moments. In 2008, December 2008, they announced that a recession had started a year earlier, and that was after something like a 30% loss on stocks and 8 million jobs lost. So it's really kind of an after the fact kind of thing. The NBER, they look at all kinds of things like consumer spending, retail sales, besides just that GDP number. So not yet technically in a recession, but it sure feels like that way to a lot of people.
Same here, Joseph. My mortgage rate went from 2.5% to 8% in 6 months because I'm in a Polish currency. Imagine all the homeowners around me here that suddenly can't go on vacation or something like that because their interest expense tripled. And if you are having, let's say, a 20%, let's say, mortgage rates cost based on your salary, that's now 40 or 50% just 6 months later. So, and then also the prices in the shop are more expensive. Fuel in Europe skyrocketing, gas prices, electricity because of the Russian war with Ukraine. I mean, it's a no-brainer. I don't need to wait for the numbers for this.
No, and I don't think we've seen the worst or the last of really the economic effects of all this. Interest rates continue to go up. I think the market is way ahead of itself, right? In rebounding over the last few weeks. Like you said, mortgage rates are skyrocketing. That's adding a lot of money and really pricing a lot of people out of the housing market. We're just now starting to see consumer spending come down. Yes, wages are going up, but not nearly as much as prices. So exactly. people are getting poorer, and I think that's really going to start showing through over the next few months. And there's going to be no doubt that we are in a recession.
Alexandros has asked, "What do you think of the long-term debt cycle talked about by Ray Dalio?"
I really, what fill me in. I really haven't kept up with what Ray Dalio is saying, just because he just says so much and so often. I think he's kind of the broken clock a lot of times, right?
Yeah, so Rich reminds me the last season of Stranger Things, which was awesome, but it's effectively saying every 40 years there's a debt cycle. So let's go back to the 80s and such. And he's also talking a lot about the changing world order at the moment with China. So usually the end of the debt cycle also could lead to civil war, populism, these kinds of things. Mm-hmm. Sometimes he keeps those topics separate from each other, but most of the times he mingles them in here.
Sure. Well, I think, I think he can be right on those longer term universal forces like populism, like rising China, what it means for a lot of things. I know he's been calling for a crash in the dollar for years. And of course, we've seen the dollar stronger than it's been, in decades, just recently against the euro, against the yen, and that kind of thing. So, I think you can be right about some of these big picture items and still wrong about how it's going to affect the markets. And I think we've seen that a lot in what he's talking about. Sure, populism is really becoming a problem. Not just economically, but politically and stuff like that. But how do you take those longer term trends and bring them back into some kind of a trading strategy, or even if you should trade around those? I don't know.
Yeah, I have no clue either. The only thing I know is that if there's an inflation this year with 10% and our retirement funds are still re-indexing with 0%, I know by the time I'm 65, there's no money left for me. So, and the only way how I know to make money that grows for me is actually the stock market. Savings accounts are not alternative. Real estate is so expensive here. And it's out of my circle of competence. So it's not much left, right? I think they say, Tina, there's no alternative.
Exactly. I was just gonna say there is no alternative. And I mean, I like real estate. I actually started with an internship in commercial real estate as an analyst. And I mean, real estate's a good inflation hedge. But yeah, stocks, you don't you can index. You don't need to spend a lot of time researching, and do just fine. And there's again, there's just no better return than stocks. Letting and while they don't always do that too well against really high inflation, they are a better inflation hedge than a lot of other investments. A lot of other, especially bonds, right?
Okay, and then the last question is from Jeffrey, and he has mentioned that you loved uranium stocks for quite a while. Are you still bullish with them? Are you still in love with them?
I think longer term, there is the demand there for uranium in that nuclear capacity, but uranium, marijuana, cannabis stocks, there's a lot of those trends that we just see those cycles, right? We see those hype cycles, and so if you're one that's going to be watching those consistently and constantly, and be investing when the cycle is lower and getting out after you've made a pretty good return and at the top of that hype, then they can be very good investments. I sold out, I'd say probably about 9 or 10 months ago out of most of my uranium investments, and just kind of waiting for that low, right? Same thing with a lot of clean energy stuff, right? It's a great long-term picture, but it's really much more of that cycle approach to investing, that you see these ebbs and flows. So, I mean, if you're a long-term investor and you just want to invest longer term with that demand picture, I think they can be great investments, but you do have to understand that they're going to go crazy, and then they're going to crash, and they're going to repeat that off over and over again, until that longer-term demand picture does take over.
And then usually then at this point, we might have our favorite stock of the week. I know you've picked 2 or 3 earlier on, but is there one stock, maybe your favorite stock of all time, that you would like to mention?
I don't know about all time, but it's a really a great stock I'm watching right now. I actually got some really good news this week. It was PayPal, right? Got some news this week that Elliott Management has a fairly large stake in it, and is going to be pushing for changes there at the company. I think they are the leader in an industry that is taking over our lives, right? We are no longer using cash. We're now ever increasingly thinking about our money in terms of zeros and ones, right? Digitally, they are the undisputed leader in those cash payments and the digital wallets. I think I saw a survey that asked which digital wallet service you use, and the top 2 was PayPal and Venmo, right? Which is both owned by PayPal. Actually, I think I always get them mixed up whether Venmo is Square or PayPal, but they basically they own the top 2, right? So they have a dominance in that. I think the potential for those digital wallets is something that a lot of people don't understand just yet. They're not really monetizing those digital wallets like they could. They could turn those digital wallet customers into basically an entire financial ecosystem where they're selling insurance, they're selling financial products, they're selling banking. That everyone with a digital wallet at PayPal or even at Square really could become a customer throughout the financial services ecosystem, and they're just not doing that just yet, right? So I think over the next 10 or 20 years, we're going to see that. We're going to see them monetize those customers in that, and those just the market value of those digital wallets alone, Venmo and the Cash App, are going to be 2 or 3 times what the whole entire company is worth right now, right? So yeah, PayPal, I think is probably the one to watch over the next 10, 20 years.
Awesome. Super. Thank you. Honestly, myself, I stopped using PayPal because of the commissions.
Uh-huh.
It's just too expensive. But I can really see the attractiveness in using it, specifically if you're also a web shop or something like that.
Yeah.
I think it is a really, really good user experience.
Yeah, and they're always innovating, or finding the companies that are innovating and adding those, right, through
Yeah.
through smart acquisitions, right?
Yeah.
The debt hasn't built up through a lot of the acquisitions they've been doing, so that's always a
Yeah.
positive. And yeah, they are on the forefront of a lot of these trends. Cryptocurrencies, and that digital wallet, a lot of these trends in digital payments, that
Yeah.
they're maintaining their lead, right? There's a lot of competition out there, sure, but I
Yeah.
think even with those higher expenses that PayPal charges versus some others, they're able to keep that lead.
Yeah, definitely. It just shows just the quality of the business, right?
Sure.
Yeah. Joseph, it was really awesome having you on the podcast, and I wanted to also share a big appreciation because I've been watching your videos, not all of them. It's too much for me from a time spent point of view.
Sure.
But what I really, really appreciate in you is that you can keep a complex matter and explain it really simple. It's really hard, right? And what I really like is it's even just the tone of your voice, and you reminded me just again about it, because I remember why I always kept watching to you. It's your tone of voice, the calmness you bring to the viewer, and I think you do an awesome job with that, because we need to empower more people to take matter in their own hands. And this is so important, I think, for the world we live in today, which becomes more individualistic. Also in Europe, government cannot support us anymore like they did 20, 30 years ago with our parents. So just want to share my appreciation, because I think you're really a multiplier for also a lot of starting investors. And I think that's also quite unique on YouTube, I must say.
I appreciate it. Thank you. Yeah, it's one of the things. Really, my mission is to bring that stock investing to Main Street investors, and really get everybody investing, because it's like we've been talking about. There is just no better return for the amount of work that you have to do. If you want to index, you buy the indexes, and you never even have to worry about stocks about it, and yet you're going to get that consistent return year over year, and it's going to help you meet those financial goals.
Thanks.
Awesome. Well, thanks a million again for coming on. It's been a pleasure. I've enjoyed chatting to you and getting to know you, and I'm sure our listeners will as well. So thanks very much for that.
My pleasure. Thanks, guys.
Okay, and to our listeners, we will see you all at the same time next week.